Prasanna Krishnamoorthy is a partner at Upekkha Value SaaS Accelerator. Upekkha is an accelerator and early stage fund for SaaS startups. They help founders build a value SaaS, that is, a capital efficient business that creates great outcomes for all stakeholders, as opposed to Vanity SaaS, that is raising too much too early without solving unit economics. The value SaaS way helps founders build a revenue flywheel engine for capital efficient growth first. So, in this podcast, Prasanna has explained in detail about Vanity and value SaaS and what this revenue flywheel is all about. We also spoke about the founder's choice architecture and what are the implications of different options founders have at different stages. One big takeaway for me was how Prasanna explained the different risks founders are trying to mitigate through the life cycle of their startup. If you're a SaaS founder, I'll go to the extent to say that you must listen to this episode and share it with every founder you know. I'd also strongly recommend this to you if you're working in any startup, or whether SaaS or not, or considering joining one. By the way, this is the first CTQ Smartcast with an Olympic medalist, even if it's a self-styled medal, at detecting startup BS. So do check it out. Hi, welcome Prasanna. Welcome to the CTQ Smartcast.
Hey Harish, glad to be on this, and thanks for having me on board.
Yeah, thank you. So we usually start with a curveball to all our guests, but I think this is right down your alley. Expecting you to dispatch this to the covers boundary. But what do you know about startup BS detection that others don't?
So I think the easiest person to bullshit is yourself.
Right.
So I think I did that for a fair bit of time. Told myself a lot of bullshit in the first couple of startups that I was in. And so I also realized that there were a lot of advisors who were giving us very good advice. But in many cases, they would couch the advice, right? They would say it in a way that was very nice.
Right.
And, as people in startups, we are very thick-skinned. And so if somebody says something that's like, couched and, said gently and said nicely, it doesn't sink in, right?
Right.
And if somebody says something that is 25% nice and actually 70% they're trying to give you bad feedback, you only hear the 25%. So I realized that while a lot of people had given us good advice, the way they had said it was also in a way that we didn't sink in for us, right? For me. So I realized that one, it's easy to fool yourself. It's easy to bullshit yourself. And to get through that is not easy.
Right.
And so founders, obviously, as founders, we have to believe that there is going to be a future which is rosy while, walking on a bed of thorns. And that means that you have to believe your own bullshit for a little while. Otherwise, you're going to be like, man, my feet are bleeding. Let me get off this bed of thorns.
Right.
So that is the hardest bit. And so once I realized that, I have to be able to detect my own bullshit. When am I selling bullshit to myself? Then I realized that I'm also getting better at detecting other people's bullshit. And many times it happens that many people have told them that, but again, many people have told them that in a nice polished kind of way. And the founder is like, oh yeah, what you're sounding sounds great. Looks like you like what I'm doing. Let me continue. When the feedback is the exact opposite. Right. So I decided that I have to be very blunt. And so one of the things that I warn lots of founders when I start talking is, I don't know if somebody warned you, but I'm very blunt.
Right.
Because that's the only way to get through that thick skin and break that bullshit. So that's why I gave myself an Olympic medal at bullshit detection.
Okay.
Because it helps the founders. I truly do it because it helps the founders. I think in our ecosystem, in our kind of a culture, we misunderstand being nice and being kind.
Correct.
Right. So I want to be kind. I don't want to be nice. And so for me, being kind means that if I have to be a mirror and reflect something to a founder which is not pretty, I would rather do that than apply a zoom filter where they look nice in the mirror. But that's not being kind in the long term.
Right. Yeah. It's very interesting because just yesterday evening, I was having a discussion with my co-founder and we were talking about our clients who are founders typically having this reality distortion field, right? Correct. And it is needed for them to go ahead, right? I mean, in fact, I was joking that, see, there are 5 chairs here. The founder is going to believe that there are 15 chairs and it's going to make that happen, maybe get close to 12, 15. But after a point of time, they need to also start accepting reality, right? And that doesn't mean toning down their aspirations, but just starting to think more about systems, processes, understanding their own negatives, if you may want to call it, or areas of improvement. If I have to, also sugarcoat it. And that's where usually this challenge comes, right? There's this tension that, yeah, you're sucking the soul out of my startup and this and that. So how has your being blunt been taken by, people that you interact with?
Yeah, so I realized that when I want people that I'm being blunt, it works much better.
Right.
And I mean, the good thing is in the B2B SaaS kind of an ecosystem, people are sent to Upekkha saying that they will tell you as it is.
Right.
So people come in forewarned that, okay, this is not going to be, pretty. Right. But, there are many cases where we've literally brought founders to a realization of that they should, probably move on from this startup. Right. And so that has happened. That is something that we've done quite a lot of times, where I'm not saying, hey, you should shut down or something like that, but we provide the comparables, we have them talk to people, different people, tell them, these folks who are in these kind of places, and therefore, what are you telling yourself? So one of the tools that works in that kind of area, and I literally was talking to a founder yesterday where I was saying this, is that a lot of our founders in the B2B context, right, they become code sevaks. So they want to do seva to others. They end up doing code to do seva. In many cases, they're not getting paid enough. Right. So they don't have unit economics. So if you don't have unit economics in a B2B, essentially you're doing seva.
Correct. Yeah.
And now if you do seva for somebody who's poor or in an orphanage or whatever like that, fine, go do it, right? But you're trying to run a profitable business is my assumption. Correct. So why are you doing seva to a business?
Right.
And that hurts a lot of tech founders, right? And then because the concept that we are trying to drive is, every line of code that you write, whatever you do, how profitable is that for you?
Correct.
It's not just about, okay, X number of people are using it and or whatever, right? You might have sold it, but actually in most cases, a lot of products, 90% of the code is not even used because they built so many features which are not being used at all. And founders don't want to accept that, right? So that is the bullshit that we're talking about. I am building n number of new features thinking that it will get me more revenue. Right. But in fact, out of my previous n features, n-1 features are not used. Right? Only one feature is being used. Now why do I think that if I double the number of features, double the line of code, suddenly revenue it's not going to increase, right? But founders are so attached and they bullshit themselves, saying this customer uses this feature, that. Have you gone and actually checked? Correct. Right? And one of the things that we make people do, for example, is you say, instrument your code and tell me which feature is being used how much. And they don't want to do it. Right. Because they know what it is. They know the answer. Right? So they don't want to do it. Because then they will have to face that, this feature which they spent 18 months building and only one customer out of your 40 customers is using it. And you spent literally probably, anywhere between $100,000 to, if you account for it, probably $500,000 to build that feature. It's only one customer is using, no customers are buying. And now you're telling me that you have another list of 10 more features like this, which are going to get you more sales. Right. Then I don't have to ask anything beyond that. Right. The founder looks at it and is like, she or she is like, okay, yeah, I see what you're saying. Right. But getting them to see that is not easy.
So, one thing that stood out for me was that, people are being sent to you to get the blunt news, right? So they are probably already self-selected then, right? They know that, yeah, I'm here forewarned that, okay, Prasanna is going to just blow me to smithereens and, I need to be ready for it. How do you deal with the innocent, somebody who's not ready for this?
It's the same. I just tell them I'm going to be blunt. I'm going to tell you this. If they don't know me from before, they get a shocker. Right. I've had cases where, our second cohort, one of the founders still tells people, I spoke to Prasanna in 2015 and he told me these things. I didn't understand what he was saying. And then when 2 years later, I realized what we had just done a lot of mistakes that he said we should not do. But only after I did those mistakes, I realized that, that's what he was trying to warn me about. So I have, quite a few cases of people remembering that. There are quite a few cases where people said, thank you for like saying this, because we've spoken to lots of people, but nobody has actually said it clearly. And it's usually nobody has said it clearly is wrong. People were telling them, but nobody told them in a blunt and transparent way. So lots of people have thanked. Some people get pissed off, very few, but some people do get pissed off, saying, "What do you know about this?" And I'm like, "Sure, man, it's your business. You run it the way you want to." I have seen lots of B2B businesses. If you're a B2C business, I'm not even going to comment on your business, right? I tell you, I don't know. But if it's B2B, then I have seen, literally, I've spoken to probably 1,000, 2,000 founders in B2B. I've seen various different SaaS models. So, I can kind of bucket you into where you are compared to other founders who are trying to be on the same journey. We have some very good mental models for B2B and SaaS. So when I put your startup into that mental model, I get some conclusions fairly quickly, which, may be difficult for you to understand how I'm coming to those conclusions. But I usually try to explain the framework. We've written about a lot of those frameworks online. So I refer them and say, go and see this video. Then you might get what I'm saying. So, we're able to jump to that kind of a potential set of issues that people come into quickly. So most people take it well.
So one thing that I've noticed is usually founders at least start with the assumption that whatever they are doing is unique. It's the first in the world that's happening. A lot of the times the articulation of the product or solution might be very unique, but the underlying core business metrics usually are similar, if not the same, right? So how difficult is it for these engineers or tech founders to build that appreciation for the underlying business dynamics of the company?
Yeah, so the internal company metrics for a B2B company are mostly similar. But the stage at which we are typically working with founders, the internal metrics don't matter. There's nothing.
Correct.
So what matters is the external things. And the external things typically are much more qualitative than quantitative. So most of the time, what we are trying to do is help founders get into the customers and the prospects' head and figure out, hey, which customer has problems that are worth solving. So we don't think about it as am I unique or that's not what we're trying to address at all. I don't care. Right? What we care about, and we are very boring that way, right? Most B2B businesses are very boring. Trying to help somebody who's a manager or an employee in another company do their job better. So you're trying to figure out, hey, who are these people? What problems do they have? Do enough of them have problems that are worth solving? Because those problems are urgent. Those problems are high value. Those problems are repetitive. And it's a problem that you can solve. If these things are covered and you're solving that problem with software, and you can get a recurring payment for it, whether it's monthly or annual, given the Indian DNA and Indian cost structure, you can make a lot of money. That's the math. It's not rocket science. Now, the challenge comes when founders are not looking at one unified customer persona, and they are trying to build something for 5 different customer personas. Or you think it's the same customer persona, but actually customer of type A and type B and type C are very different, even though they might be in the same industry. There's something else that is differentiating. Right. So for us, it's not about the metrics. It's about the key concept that we try to get founders to understand is problem value. Figuring out how much is that problem value. Is it high? Is it low? Can I quantify it? Is it repetitive? It's urgent. Who is it urgent for? Who is it repetitive for? Who is it high value for? That is the struggle for most founders that I've seen. What you are saying from a metrics perspective is more about org scaling. Where founders might be, generalists, or founders might be specialists, and they don't have enough of an understanding about the entire system to put a system and a process into place. So typically we see that stage after $500,000 or $1 million in revenue, where they need to transition. And we do something for them in that stage. But again, it's not about the metrics. It's about what you said a little earlier, which is, hey, what is the founder and their team? What are they good at? What are they not good at? When they look at an org structure 12 months or 24 months down, what does that org need to look for this business to be 3x or 4x of where it is.
Right.
And therefore, can you structure that org with what skills are missing and how do you scale that? The metrics are more of something that just you use to track whether you are on the right path. But in an early stage startup, the metrics can't be what keeps you, going. Because metrics are sparse, they're all over, and doesn't really add up.
I think has to be the story backed with the metrics. It has to be a good judicious combination of both, right?
Absolutely.
So coming back to founders, what are the innate things that you are looking in founders? What gives you this confidence that they're coachable, they're going to understand this? Like we discussed earlier, there is always thick skin and that reality distortion field which gets them going to start with, but they also need to be coachable, right?
Yeah. So my personal philosophy is that anybody can learn anything.
Correct.
Right? To varying degrees of success. But most of the traits or most of the things that you need for succeeding in a B2B business, you can be whatever kind of person and you can succeed. The trick is to make sure that you as a founding team have the sufficient complementary skills so that you're rounded.
Right.
But I don't think a single person has to be of a certain kind to be able to succeed. So the most important aspect in that context is, does a person feel that they can grow? Are they able to see reality as is without too much of a rosy tint? Are they ready to listen to peers and listen to others who have been on that journey before and not be defensive,
right,
and not say I know everything, right? So that's basically what we look for in founders, right? So humility, ability to listen, ability to see the world as it is. The challenge comes, I've seen some founders who are like, and I've those are the experiences from a coaching perspective that don't work out well. So founder comes, asks you something. As soon as you ask some more questions, and then they answer, and then you give some suggestions, they will say like, yeah, I've done that, or no, yeah, I was thinking about doing it, right? Hey, if you were thinking about doing it, or you were going to do it, then why come to me? Number one. Number two, yeah, sure, like go ahead and do it, right? But like, there's a lot of defensiveness. Hey, I tried that, it didn't work, or and you know that it can't be true because you asked some questions, and if they had tried it, then this is not where they would be, type.
Right.
And nobody has answers to all questions.
Correct.
Right. Hey, I know what I'm doing is what the founder wants to project.
Right.
Versus this is where it is. How can I get some help?
Right.
And being able to take help from unlikely people and taking lessons from unlikely people is something that's very important, because you never know who will be giving you a lesson that you need. So we make sure that founders of the second type don't even get into the program, or in most cases, we are not in conversations with them. So it works out well for us, because then the peer group is able to help them a lot more.
Correct.
Because then they are honest with their problems.
Right.
In the past, we've had issues where people were not honest with their problems. So then everybody ends up trying to solve something else. It's not your problem. But you didn't say this was your problem. If you said this is your problem, then we'll try to solve this together.
Correct.
But if you say this is my problem, then we're going to try to solve that together.
Right.
So that, I think, is very critical. And so now we kind of create a psychological safety within the founders, saying that between these founders, you're going to be, you should tell the truth. You have to be able to be open. Whatever your problems are, you have to say, because all the other founders here also have the same problems.
So any quick tests that you can share about how you filter?
So one is, it's driven a lot by referrals. Two is, we put this persona out that we are very blunt and we're doing this stuff. So there are some folks who come in to test that. They don't want to be part of this, but they just want to see how it is. So but for the large part, I think we have a filter process in the interview process where we just check what have they done before, how do they respond to feedback, those kind of things. Right? It's a pretty standard stuff.
Okay.
Just applied more rigorously, and if somebody fails that, if there is even a hint of a red flag that this person is not taking feedback and stuff like that, then we drop.
Right, yeah. And if you can quickly talk about the cohort, what happens when someone joins the cohort, if you can briefly talk about that.
Sure. So the newest cohort started this week on Tuesday. So we actually start very differently from most accelerators. We actually start with cognitive biases and how to make decisions.
Great.
So that's literally the first working session where we ask folks to think about what is the last big decision that they made. What is the last big wrong decision that they made? Wrong is obviously in hindsight.
Right.
Then we actually do an exercise of how cognitive biases shape decision making and how, as founders, what are some cognitive biases which impact founders.
Right.
So one is, of course, there is a positivity bias, right? So you get feedback from customers.
Correct.
10% is positive, 70% is neutral, 30% is negative. You only listen to the 10%.
Right.
So that is something that in the early stage hurts a lot. So those are the kind of biases that hit founders, and we try to help them understand the set of biases and how they impact. And you can't overcome these biases. You can't, like, these biases are there in your brain, they're hardwired. So you can't do anything. So essentially we're trying to help founders get ways to avoid getting into situations where these biases will have effects. So plan your day better, have meetings when you have more energy, manage your energy, not your time, all of those kind of things, right? So that's how we start the program. So we are essentially trying to give founders tools for them to manage their biases better, do better decision making, because founders' number one job is actually decision making. But unfortunately, most founders actually don't understand that. And they end up doing all kinds of things, sometimes avoiding the decision making, sometimes doing the decision making in a way which is very, very poor from a process perspective. So you're saying, unless you improve the process of decision making, you're not going to make better decisions. Lots of founders postpone decisions, analysis paralysis, so many other issues are there. Then we move on to the frameworks we have from B2B perspective. Number one is the Flywheel.
Right.
So we believe that a B2B business is about generating a revenue flywheel. So if you're able to build a revenue flywheel, then you can be very capital efficient. Then you can choose to be founder forever, or you can choose to raise capital and hyperscale, or you can exit. And now we have startups that are doing all three. We have 4 exits. We have 1 or 2 startups that have raised at 10 million plus kind of a valuation. And we have startups that have exited, that where the founders are basically going to run it forever. Right? They're very profitable.
Right.
They're making a couple of $1 million of profit a year. Very happy. They own 100% of the company. Upekkha holds small stake, but other than that, they own the entire equity, and they're very happy running the business.
Right.
So the inner flywheel part is a qualitative part. Which geography are you going to? Which ICP are you targeting? Within that, who has a problem? What kind of problem do they have? How do you do the positioning for them? How do you do the pricing for them? What gameplay do you have for them?
Right. Yeah.
These are all qualitative choices, and that takes about 3 months to go through. And then there is the outer flywheel, which is more quantitative, which is, how do I get my leads? Where do I get my leads? How do I convert them? What kind of model is it? Land and expand? Is it a freemium? And then get them to become a customer, get them to pay you more and more over time, and then get referrals from them. So this is all stuff that is much more qualitative. This is usually the business of business. So what we found is that from a B2B SaaS perspective, most of the mistakes are in the inner flywheel, in the qualitative parts.
Correct.
And the symptoms are in the outside. I'm not getting enough leads. I'm not converting enough. My customers are churning, all of that stuff. So what we find is founders come to us with the symptoms, and we are helping them identify the root cause, which is typically much harder. And so we are helping founders fix the root cause from the basics. And the outside stuff becomes execution. And you can always hire somebody to do execute that, but you can't hire anybody to fix the inner flywheel. You have to do it as founders.
Correct.
So that's kind of the staging of the program. And once these 2 things are fixed, then it still takes some time for the flywheel to build up momentum. And the community is there to help. We are there to help. So it might take 6 months, it might take 12 months, 18 months.
Right.
But we have companies essentially growing faster now than they were growing 5 years ago. And they are now doubling to doing 2.5x of growth with no capital at a 1 mil plus range.
Wow.
Versus when they were at $10,000 a month, they were struggling to get to $11,000 a month,
right.
$12,000. Right? So that's the kind of a change that we've seen by applying and making sure that the fundamentals work. It's slow. It's not fast.
Correct. Yeah.
And so, we do it for B2B SaaS founders, B2B founders. But the good part is most B2B founders are okay with that. because your sales cycle is also 3 months, 6 months, 9 months, right? So you know that nothing will happen fast. So that way it's like well aligned. But once you build this flywheel, and once you start building momentum around it, it's crazy. We have companies which are at like $4 million in annual revenue, ARR, which are probably doing 2 million in profits.
So you spoke about different kinds of companies and founders that you have, from exit to people who are running these things. So this is where I wanted to bring that founder choice architecture that we wanted to talk about. So usually the standard division that people see is, oh, I'm either bootstrapped or I'm raising VC money, right? But clearly there are smaller, thinner segments that you can look at in terms of this universe, and that is the kind of distinction that you are making and getting people to understand and appreciate, and that's how they're taking these different paths. So if you can just talk about what are these different choices that founders have, and is it a right or wrong, or is it more about making a choice and then understanding the trade-offs?
Yeah. So I think one of my friends, he heard this from his mentor, said there are 3 jobs for a CEO. Right. One is keep money in the bank.
Right.
2 is make sure that the entire team is aligned. 3rd is always have options.
Correct.
Right. And so the 3rd is always have options is called optionality.
Right.
So having options, you want optionality. You want to be able to make choices. So the problem is a lot of founders box themselves into a place where they have no choice. Right. There's only one path. So you don't have choice. It's no longer you driving. Right? You're being driven by your previous choices. That's it. Right? And so what we find is that founders lock themselves into such a path too early. One is by falsely, thinking that I have to be bootstrapped or I have to be VC funded. Right. It's a false choice. Correct. Their universe of choices is dramatically shrunk. What we are saying is, if you are capital efficient, then your optionality is higher in the future than if you are capital inefficient. Right. Because if your balance sheet is red, then you are dependent on capital providers. And the golden rule, if you've heard about it, is that he who has the gold makes the rules. Correct. Yeah. So if you need gold to run your business because it's in the red, then whatever rules the capital provider makes are the rules you have to live by. Correct. But if your balance sheet is black and you are profitable and you are capital efficient, then the capital provider typically is after you to take capital. Right. And in that case, you make the rules. Correct. And therefore, your choices stay open. To us, that is the fundamental dichotomy, not bootstrapping versus VC. Correct. But are you in control of the journey by being capital efficient, by being profitable, by being cash flow positive, rather than being at the mercy of someone else because you are not cash flow positive? If they are capital inefficient at this stage, then it's a problem in the future because they would have burnt too much equity to figure this out. The investors are looking for a 10x, 100x return. Right. So you are set on that path. But if you've been capital efficient and you've taken only angel investors, small rounds of capital, etc., then once you say hit $1 million or $5 million in revenue, then you can now take a fresh look. And what we've found when lots of founders cross $1 million is they look at it and say, you know what, this is not a great market. Maybe I can get to 3 million, 5 million, 7 million. I don't think I can get to 100. Right? And so maybe I want to sell this and build another business. Now, if you're at $1 million revenue and you've already raised 10 million, that sale is not going to do anything for you or your employees. Right? There's going to be no outcome for you or your employees in that sale. But if you raise only 200K and you're at $1 million, and you can sell this business for 10 million or even 5 million, then your investors who invested 200K are probably going to get 7x, 10x or even a 5x return. Right. You are going to make money. Your employees are going to make money. Now you have enough money to bat again. Correct. Right. The third thing that happens is we've seen founders who look at it and say, you know what, now at $1 million, I can get to 5 and 10. I don't need to spend a lot. I don't even need a lot of capital because I'm generating it. Right. right? And of course, today there are revenue-based financing that is non-dilutive. I just need a little bit of capital, or I need no capital, and I can get to 5-10 million. I don't know whether I can get to 100, but I love this space.
Right.
I have some folks who are security space. They don't want to do anything else. They're like, I'm in security. I'll be in security for the rest of my natural life. And so they're like, yeah, what else will I do if I sell this? So I'm just going to build this. I'm growing 40, 50%, 60% year on year.
Correct.
No outside capital, very profitable. I'll be founder forever. Right? And we are happy with that.
Right.
And the third is they look at it and say, look, I'm at $1 million now, and I can see how to get it to 30. And maybe from 30, we can get to 100. Market is there. I'm actually winning some great deals. I don't see any bottlenecks to get to 30. Of course, I need a better org. I need a better team. I need more capital to do those things. But the path is there.
Correct. You can see that.
I can see it. As a founder, I can see it. Right? When that happens, then we say, should go for hyperscale, right? Raise capital. Be judicious still. It's not that you're going to just burn money. Because the good part is by the time the DNA of the org will be to be capital efficient. And so then therefore they raise capital, and IMOCA is a recent example. They raised only about 100K, got to 700K, then raised only about 700K, got to upwards of 3 million, and now raised a larger round because from 3 million they can see how to get to 30 and 50. Right? It's not even, there's no unknowns in the 30 journey other than team.
Right.
And that's fantastic outcome for the founders, right? Because when they started up, they were thinking 7 years ago, they were thinking, if I can sell this business for 5 million, I'm good. Right now, they're obviously at a valuation of a little less than 100 million.
Right.
So it's fantastic outcome for the team, everybody. Right. So that is the third option. But let's say somebody took, a couple of $1 million, diluted 30%, 35%, and are now slowly getting to $1 million. The first two options are not possible anymore.
Correct.
Right? You can't sell your business because you will be selling for less than what you raised in most cases.
Yeah.
Second option is not possible because the investors are fairly, right? It's absolutely fair for them to ask, where is my money?
Correct.
How are you going to give me a return? Right? And they can't give a fair return. And these are the companies that generally get acquired or go for a small exit, and nobody makes money.
Right.
It becomes a game of attrition.
Correct. Yeah.
So when I look at most startups and divide that into these three possibilities, people taking capital too much too early basically are by default removing the first two choices of themselves and their team becoming successful, and only shooting for the third.
Right.
And in a B2B SaaS, B2B context, where cash flow is possible, where profits are possible, where all this is possible, I think that most founders should keep these options open until they cross at least $1 million or 2 million in revenue.
Right.
And then they can lock on to the path.
Right.
But the moment you raise something like 100 million,
you're committed.
Then you are saying basically I will go IPO.
Correct.
Right. So you're trying to shoot for a $1 billion plus exit, which there are only a few companies in the world which can buy you for $1 billion plus. Not saying it's not possible, but basically you're saying I will go IPO.
Correct.
Right. So do you want to lock your choice that way too early? That's the optionality bit that we want to empower founders with.
Right.
So most founders don't know that these options exist, and you probably don't have the data today to make a good informed decision on which of these choices you should throw away. So until you have that insight, don't throw away those choices.
Right.
That is what we are trying to educate founders.
So this is like you said, I think educating is the right word here to be used, right? I know for a fact that many founders don't know this, right, or don't understand this, and a lot of times they perceive that they have been pushed into a corner where while they have probably not, right? They still have enough. So what can be done to sort of just increase the awareness, get people to understand these things better? You are doing a great job. People who come to you get this, but how does this get better for the whole ecosystem?
Yeah, I think that's our goal, right? So what we're trying to do is talk about value SaaS.
Right.
And that's something that we keep repeating ad nauseum. We said, don't do vanity SaaS.
Correct.
Right? And so if you're doing value SaaS, then you are capital efficient, you have unit economics, you are then keeping those choices open. What we are trying to tell people is, look, you became a founder because you wanted to make choices. Most cases, founders become founders because they're in a situation where somebody is not letting them make choices.
Right.
And now they're like, okay, I want to make choices. I want to be the driver. Let me try.
Correct.
So if you are getting into that situation and then locking yourself into a path, then makes sense. Right? So that's why we've coined this value SaaS term and saying no vanity SaaS, and we're trying to push that as a message. Right? And the good part is, like, there are some founders who have now crossed 10 million, $15 million who are not from Upekkha,
right,
from outside, who are identifying as, hey, I am a value SaaS founder. This philosophy makes sense to me.
Right.
So that is what we are trying to do to educate people, because our marketing budget is nearly zero.
Correct.
Versus the folks who are selling vanity, their marketing budget is very large.
Right.
So we can't compete with that directly.
Yeah.
Right. So we're using a classic guerrilla marketing kind of a tactic, because obviously nobody in the world is going to say, yeah, I want to build a vanity SaaS business.
Is there a cultural context also involved here? Do you see people from a certain kind of a background resonate with this better? Maybe geography, India, abroad. Is there any lens like that, or is it wrong to even think on those lines?
So my sense is that because we are saying B2B, value is already a large determinant of most people's calculus. Right? So we're not going after B2C, where that value is generally very different, right?
Correct.
So in a B2B context, most people who are doing B2B out by choice understand that you're selling value.
Right.
So it's not a stretch.
Right. Yeah. Right?
Some cases they don't realize that they are doing vanity. And that's because they are on this trajectory, because they think that that's the right thing to do.
Right.
But when they hear this, then it's not something that you can say no to. The misunderstanding that people have is, if you want to do value, you have to bootstrap. That's not the point.
Right.
Capital is a tool.
Correct.
Right? You have to use it judiciously. Right? I'm not saying build a skyscraper without using tools.
Right. Yeah.
I'm saying, if you are building a skyscraper, understand what tools you need.
Right.
If you end up selling the whole skyscraper to buy those tools, then you would have built the skyscraper, but man, it doesn't belong to you anymore.
Correct. Yeah.
Once they realize that part, and the math is like this, right? When you look at public companies in SaaS, in B2B, the companies which have done really well after IPO, many of them had larger founder equity.
Correct. Yeah.
Canonical example, of course, being Microsoft, where the founders basically never took a venture round. They only did a venture round to get a VC who had experience taking a tech company to the public market. And so the founders kept most of the equity. Right? So those companies have done extraordinarily well. Companies which diluted too much have not done as well. And this is fairly well studied.
Right.
So once we share that, hey, there is a company, for example, called Viva, where the founder took $7 million in equity, spent only $4 million out of that, got to $50 million in revenue, did an IPO, is now at $1 billion in revenue in ARR.
Right.
On just 4 million raised.
Correct.
And by the way, this was not 40 years ago. They started in 2008, right? And they're in pharma CRM, which is as boring and as niche an industry as you can possibly imagine. So once we share some of these examples, then they realize that, then you go and look at some of the, much more marketed companies and look at their S1s. And you realize that the founders have 3% equity at IPO, 4% equity at IPO.
Yeah.
And then you're like, okay, you built the skyscraper, right? But you paid so much for the tools and the material that you don't own anything in the skyscraper. You don't even own one floor.
Yeah. Except for the one parking spot.
Yeah, maybe you got a parking spot, right? Now, that's for the founders, right? But the employees in many cases get it even worse. There are some $200 million exits where the employees got nothing.
Right.
Because they had raised $150 million and did a $200 million exit. Employees don't get anything out of that.
Correct.
To me, that is a bigger shame.
So again, sorry to interrupt, Prasanna here. What about the people who are joining these kind of startups. It, like you said, it is extremely important for them also to know how founders are thinking, right? Do you see this, as being a criteria for people when they join startups?
No, people are thinking higher valuation is good. They don't realize that higher capital raise means that more money has to be returned before they will see a single dollar. And there is this trend of liquidity from venture capital via ESOP buyback and stuff like that in companies that are not yet profitable, have not yet proven out their business model.
Right.
I have no clue what people are thinking here, right? It's just like giving us a higher salary.
Yeah.
Right. So, and people are thinking that equity is worth something. So this makes no sense to me whatsoever from a fundamentals perspective.
Correct.
So I'm like very, very confused about some of these things.
Right.
Over like cycles from 99 to now, multiple cycles of going up and down. Whenever things go so high up that I don't understand like how fundamentals will match what the hell is happening, then I've learned to trust myself saying, look, fundamentals are fundamentals.
Correct.
If there are no fundamentals, the skyscraper is going to come crashing down one day or the other.
Right.
And we've seen that in the Indian case with Snapdeal, with Paytm, with many others where where are the fundamentals?
Right.
And those employees are suffering now.
Correct. Yeah.
The founders made out, but the employees are suffering, right? So I think luckily in B2B, it doesn't happen as often.
Correct.
Because your customers will not let you go ahead of fundamentals too often. It still happens that in B2B people raise too much, don't get to enough revenue and exit. It happens, right? But not as often as in the other side of the business.
Yeah, I think being in that non-glamorous space is almost like a self-selection criteria to be thinking with your feet grounded.
Absolutely. So I've seen multiple cycles of where investors get excited about B2B.
Right.
Then they invest into B2B, raise up the valuations.
Correct.
Then they realize that, boss, this is not a business where you can just grow your revenue by 10x every year. It is very hard.
Right. Yeah.
Your business, your revenue is going to grow only by 2.5x, 3x year on year. But it's 80% gross margins. You can't say I will sacrifice gross margins to grow faster. Doesn't happen. You will sacrifice the gross margins, growth will stay the same.
Correct.
So that once they understand that, then after some time, new shiny toy comes. That is e-commerce or quick commerce or Web3, NFT, whatever, and they're like, "Ooh, shiny, let me go there," and they're gone, right?
Correct.
And then some sanity returns to the B2B side of things, right? And I've seen like 3-4 cycles of this happening.
Right.
And I'm good because most of we are filtering and we are taking people who are good to build a business for 5 years, 10 years, 15 years, because that's how long it takes to build a business. You can't do it in 2-3 years. It's a myth. And what I come back to and what I tell founders is, look, in 1991, there were 200 companies in India doing 100 million of IT services exports. In 2002, there were 8,000 companies doing $12 billion of IT services exports. That's what's going to happen in SaaS. Stick around, play the fundamentals, play the long game. You're going to be one of those folks who get to high revenue. Now, for you, for your business, for what you're selling, for the market that you're selling into, that high revenue, maybe 2 million, 10 million, 100 million, 200 million, we don't know upfront.
Correct.
Right. Whichever type of business you want to build, let's try to build it in that direction.
Right. Be deliberate about it.
Be deliberate about
it.
Right.
Right.
Can you always try to build $100 million business? Not possible.
Right.
Can you try to build $1 million business in any B2B space? Yes. So I like what Girish said in his S1. Said Freshworks dreams in increments. So we dreamt about the first $1,000 revenue, then $10,000 revenue, then $100,000 revenue, then $1 million revenue, then $10 million, then $100 million, and now they're thinking about $1 billion and $10 billion, right? So that dreaming in increments works very well in B2B.
Right.
And we help people build the foundation in such a way that they don't realize it, but we help them build the foundation in such that these choices are aligned where, instead of locking yourself into a market where you could only build 3 to 5 million, maybe you can expand into adjacencies, or the same market you can get to a 50, 100 million. So that's how we kind of help founders shape the fundamentals.
Right.
So they're still dreaming in increments, 100K, 500K, million, like that. And as they get to each milestone, however, hopefully things open up. And that's where the optionality plays. So that you are having options to move into adjacencies or expand or increase your TAM in certain ways.
Right.
And historically, that's how it's been for
Yeah,
most B2B
yeah.
companies.
Mm,
Right?
mm.
They don't start out in a market which is already.
Correct.
Viva, as example, when they went IPO, analysts, public market analysts, they were already at 50 million revenue. Public market analysts said that this total market size is only 150 million. Don't buy Viva stock.
Okay.
This was 8 years ago, 7 years ago or 8 years ago, 2014, 15, I think. Right? They were already at 50. And the analysts were saying they can't go more than 150 because the entire market is 150.
Right.
Today, they're at $1 billion in revenue. Right? So how wrong were those analysts?
Correct.
Right? That one company could get to $1 billion. It's crazy, right?
Yeah.
So most companies anyway are building in increments and dreaming in increments. We're saying that's a capital efficiently. If you want to do it, that's how you have to do it.
Correct.
Otherwise, we see somebody saying, I'll get to, 10 billion in revenue, $1 billion in revenue, and then their first round is valued at 50 million, 100 million. They've raised a lot of capital. Is it working? Are you able to get to a genuine good quality of 100K of revenue, $500,000 of revenue, $1 million? That is just getting lost.
Correct. So, we've come to the end of our allotted, 1 hour. I think this deserves a follow-up session. We're going to do that anyway. But couple of questions to, sort of round up this thing. So, at different stages, we spoke a lot about the initial stage. I don't want to, bucket it into, seed, angel or anything like that. The stuff that we spoke about. But if you want to generally put, say, different stages of the life cycle of a company, right? From, the first MVP to, say, IPO/acquisition. Okay, let's just take that as a life cycle. What are the important challenges that founders overlook, most commonly at different stages of this life cycle?
Yeah. So, my mentor Ravinara, I think in the Microsoft Accelerator, we had this nice framework for thinking about it as what risks have you mitigated? What risks do you still have? And so the number one risk of any business is market.
Right.
So until you prove that a market exists for what you're building, right, there is always a big risk, right?
Yeah.
Actually, before that, there is a tech/product risk. Whatever you're building, does it work?
Correct.
Right. But in most cases, it's not a challenge. Other than the deep tech, in B2B, it's not a problem. It will work. Second is market. Is there a market for what you're building? Is there a large enough market for what you're building?
Right.
Is there a market where you can build this product and sell it with unit economic viability? So most founders are going through a journey where they're first ameliorating the tech product risk.
Correct.
Then they're ameliorating the market risk. Right? Then there is basically a execution risk. Are you able to assemble the right team? Are you able to get the right people? Are you able to point them in the same direction? Are you able to get them to do the work? Are you able to deliver quality repeatedly? All of those things are an execution risk.
Right.
And so execution risk never goes away.
Correct. Yeah.
But you can reduce it over time. And finally is the finance risk. And finance risk again never goes away really. Even if you are extremely profitable, it's always, you're generating cash flows, you're spending money. So when you think about a startup as a journey of mitigating these risks, one after the other, the mistake that lots of founders make is that they mitigate the tech product risk, but don't actually pay attention to the market risk. And they put off the market risk. They've spent too much money on the tech and product, don't have enough money to mitigate the market risk and fail. So that's why we usually tell founders, focus on the market risk. Because tech product, in most cases, you can build almost anything.
Correct. Yeah.
Focus on the market risk. Once you've mitigated the market risk, your product works, then you can figure out to invest more in the tech and product.
Correct.
This, of course, does not apply to somebody making cancer drugs or somebody doing deep tech, some kind of AI. But in most B2B cases, like market risk is why companies fail. And then once they cross that market risk threshold, if the founders are not sufficiently skilled, then they fail because they don't do the execution properly. Right? They don't take it seriously. They don't know how to hire an org. They don't know how to delegate, or they over delegate, or they don't know how to hire a senior team.
Correct.
Right? They don't know how to hire a leadership team. They don't know how to work with other leaders. They have some kind of a bottleneck in their own capabilities. They're not able to scale up. That leads to a lot of execution risks. Right? Finance risk the good part of the world that we are living in, there are different types of finance available, infinite varieties of finance, infinite amount of capital is available. If these two, if these three things are sorted, if product is sorted, if market is sorted, and if tech is sorted, capital is available.
Correct.
Right? Of whatever kind you want. Right? So that's how I see the stages. And so when I'm evaluating, I'm not looking at it as, pre-product, etc. I'm looking at how much of the market risk have they mitigated. Right? Will they be able to build a product?
Right.
It's more valuable to me than, hey, they built a product, but they have no clue about the market. It's much worse for me.
Yeah. I think that's a great way of looking at it. It clears a lot of things for me personally as well. One of the last questions, what books, people, podcasts have shaped your thinking, and what do you recommend to the founders in your cohorts and others?
Sure. So I think one of the books that I recommend a lot is Goal.
Correct.
By Goldratt.
Yeah.
Blurring for this to be.
Yeah, it's getting blurred, but yeah, we'll link to it.
Yeah. So Goldratt, it's a fantastic book. I think anybody running a startup should read Goldratt's all his books.
Yeah.
Especially the third book, I think, talks about software.
Yes.
Book talks about software. It's fantastic. It's something that is a must read. Then I think that's a good start. If you're building a tech business, this is a hard book to get. It's very expensive. It's called Selling the Wheel. If you're anything in tech, if you're building, this is fantastic read.
Okay.
It's mind-blowing. I never heard of it till this year. Bought it. I wish I'd read it 20 years ago, but it would have been very different.
Okay.
The author actually wrote it in 99, I think. It's just mind-blowingly good. So these are a couple of books that I think are really have shaped how I think about startups and building startups and stuff like that. I'm not a big podcast listener. Okay. I like to read books. I read a lot.
Right.
So if you want book recommendations, I literally have a large pile of books here. And this is just some books. There's a bigger pile somewhere else.
Right. Yeah.
Book recommendations, too many. But these would be I think for any founder, if they read these two books, they will understand a lot better of actual dynamics of how things work in a business than they would otherwise.
Okay. And any people to follow on social media, Twitter?
Yeah, so my co-founder Rajan is much better at Twitter than I am. MT Rajan, MTRAJAN.
Right.
I think in a B2B kind of a context, I think there are lots of folks to follow. There are a couple of folks who run a interesting site called forgetthefunnel.com, Claire and Gia. So they put out some really good stuff, very grounded, very driven by fundamentals, very, very good stuff on how to build, and they don't focus more on the product side of things, but on the market side of things, on how to choose what problem to solve. And once you've done that, how do you market that? How do you sell that well? They do very, very it's very clear, right? It's very clear, and there's no fluff and stuff like that, right? Then Jason Lemkin has sold a business, runs Aster, does really good content. In an Indian context, Paras is a good follow on social. He writes a lot. A lot of the Indian SaaS founders are not very active on Twitter or social media, so not much to follow there.
Yeah. I think, but there's space for somebody to sort of storify all the great work that they are doing. Maybe accelerators like you should also put the spotlight on these people. I've come to know so many people through following people like you, right? That these are the guys who are doing great. Especially because, like you said, the space is not there in the news all the time, right? Yep. So somebody needs to put the spotlight on them. So yeah.
Absolutely.
And I think you guys have got great content on your site as well. So I recommend that.
So we have
from my
our
side.
own ebook as well, right? The
Right.
Value SaaS Guide.
Correct.
Which we recommend to all SaaS founders who are growing up.
Right. You've been too humble not to recommend that earlier, but I will do that.
Thank you.
Yeah. So final section, Prasanna, I'm going to ask you 3 things, and I want your hot take on what is the future relevance of that, right? So first is, what do you think is the future relevance of traditional startup centers like Bangalore, Gurgaon, Hyderabad, Pune, Mumbai? Are they going to still be relevant post 2020? Is it not that important? What do you think?
I think for folks trying to figure out who to work with and how to work with people, there's going to be a transition period when people don't know how to work remotely, where these centers will work really well. But more and more, we'll see companies where founders have never met each other in person, and they're working together. It's working great, and they're making revenue, and they're both sitting in some random places with no cost of living, and they're building $1 million businesses, $100 million businesses. Right? So yeah, I think they are relevant for investors, because investors like to be close to the startups that they're funding.
Right.
But for founder, I think it no longer matters as much. But building that early network used to be easier because you were in the same company, you were in the same place, you meet people and stuff like that. I think that is going to evolve in a different way. I don't know how, but I think for that it's still worthwhile coming to meetups and doing stuff. Right? But I think the function of work as a networking space is going to change, not go away, but change how it was done. And there is going to be more emphasis on networking for networking's sake, that people do go to events, go to conferences, go to these kind of things just for networking, not for the gyan that the conference is giving, but just for the networking. I think that is going to increase, but that will not be in a Bangalore or these kind of places. Right? It could be anywhere.
Okay. What do you think is the future relevance of incubation centers and these entrepreneurship courses that are being run in traditional institutes?
So the only two that I've heard work well, one is at Babson College in the US. Another, my mentor, Professor Saras, she teaches a course in University of Virginia.
I've taken a course of hers.
Yeah. So those I've heard are good for shaping actual entrepreneurs. A lot of the other people who are teaching entrepreneurship at these entrepreneurial centers have never done a startup in their life. If a startup hits them in the face, they will not know what a startup is.
Right.
There it's more cargo culting of build a business model, do this, do that, versus real work of building a startup, which is figuring something out of nothing.
Right.
I think those centers where it's not being taught by entrepreneurial folks, it's not being taught by people who've done startups before, and maybe unfortunately they're in a place where there are not too many startups. They might be providing inspiration and they might be providing a context, but I don't think that they're teaching useful skills, right? Which is the 99% of, unfortunately, entrepreneurial education today.
Okay. And final one, what do you think is the future relevance of the Olympic Games?
I am not a sportsy person.
But you have to give me a hot take on this.
I've never watched the Olympics. Like I literally have no clue. I don't care about it. Right? So if it stays, people are happy, fine. If it goes, doesn't make a difference in my life.
Completely indifferent about it. So maybe there are going to be more people who are going to be like you, who are going to be completely indifferent about Olympic medals. As we know, I think over the last 6 or 7 editions, it's been a loss-making, venture for cities. So it's not really been, economically viable, and cities have been backing out of, even bidding for games. So
I see.
Going by your lens of evaluating ventures, it's already not doing well. Right?
Yep.
Yeah. So on that note, I think this is a fantastic conversation. We covered a lot of area. We spoke about your BS detection, vanity metrics, value, SaaS. What should founders be thinking? I think there were a couple of truth bombs, thrown very nonchalantly there, which we're going to try and capture and put them in the promo of the conversation. But thanks a lot. This is fantastic.
Thanks, Harish. Thanks for having me on. Pleasure to be here.
Yeah. Stop this.